market is very interesting. What most people don't know is that it is a very, risky market, but it can also be a very rewarding market. Equities market is highly risky, but guess what? It can also be highly rewarding. So it's typically termed as a very volatile market. But for a young person at 25, why not? You can take that risk because you're planning for something in the next 3 to 5 years. Now, the equities market is also a pretty much long-term market. It is not short-term, guys. People that tell you, oh, I want to invest my money in the Nigerian equities market and get 100% in 2 months, don't do it. It doesn't work. The equities market is not a short-term market. It is for the long term. Have a long-term view. Think 18, 24 months. Yes, 18 to 24 months. Let me contextualize that for you. If you put your money in the business of a friend, do you think when you put your money in the business of a friend, do you see returns in 2 months' time? Probably not. You probably won't see a return when you put your money in your friend's business for the next 18 to 24 months. So why would you think investing in a company on day one should yield you a return in 2 months? That's not practical, is it? Absolutely not. So the equities market is long-term in nature. Now, I would say for a young person, put 40% of your money in the equities market. Why? Because you can invest in something that can potentially be maximized over a period of 3 to 5 years, which is enough time for you to, put your money in and for you to see a significant return in your investment. Then what happens to the remaining odd 40% that is left? Then we can say, okay, you're a young person. Can you look for some land that you can pay for on an instrumental basis? But where would I find that land? There are lots of information on the internet, lots of information if you talk to your friends, talk to your family. There's some land there. And by the way, do not scoff your nose at land in far places. Don't be like me. I made that mistake a couple of years ago. I regret it. Look for land that may not seem attractive. It may seem like some remote area. You can't even pronounce the name. Take a chance. I promise you, the way the population is expanding in Nigeria right now, some of those opportunities, if you invest in them now, you could be smiling to the bank in 3 to 5 years. I'm speaking from experience. Don't learn the hard way. Then what about the remaining odd 20%? The reality is that we live in an economy where we're monoproduct economy, which is, we're very heavily reliant on oil as a source of foreign exchange income. It means that we're susceptible to, effects of the global market on our economy. And to that, I would say, have some sort of mini exposure in foreign currency. Look for what you can do. You can save up a small amount of your salary every month. It could be anything, just a little bit of money in, some sort of foreign currency. That wouldn't be a bad idea at all. Think about it. Now you've done all that. Then, so what would I say for a 40-year-old person? Now let's move to 35 and 40-year-old person. Now at this point, I'm thinking to myself, you've worked for a couple of years, probably about 10 to 12 years, right? Absolutely. You're thinking, what is the next thing? You're probably married or not, or you're thinking to have children or not, or you're probably thinking to buy a house or a car, or there's some major investment you want to make. So it means that there's a lot more urgency around you. Also, you're accustomed to standard quality of living and you want to maintain that. And also you have people that are probably depending on you. So your ability to take risk is a lot lower. You can't take as much risk as a 25-year-old. You have to be a bit more cautious, right? Absolutely. So it means that, cash usage is more pertinent to you than when you were younger. Your need to spend is a lot higher. It means that what you're saving for is also a lot more urgent. How do we combine that? I would say for a 40-year-old, you want to probably have about 30% in some sort of cash instruments. You want to do some fixed deposits, some treasury bills. You want to put your money in that because you have a need to maybe spend much more than anticipated. And you're looking for more in terms of maybe in your life. I would say equities probably takes about maybe 25%. You may need to pull back a bit, right? You can't put as much money in equities. You need to be more conscious of what you're doing. Now, land becomes a lot more interesting and property becomes a lot more interesting. So in this thing, at this age, you're thinking, I want to buy a house. I want to start thinking of where I want to live. I want to have the quality of life I want. I need to start putting my thoughts around that. So land becomes a lot more important. Housing becomes a lot more important. So you probably see about another 40% of your income going towards that. Then 10% could also go into alternative assets. You could look for small businesses to invest in that will give you high reward. You could look for foreign exchange denominated assets that you could invest in. You need to start thinking about those things, because guess what? You're getting older. Your need to earn more becomes very important, right? Absolutely. For a 60-year-old, I would say, listen, put more of your money in cash instruments. So about 30% to 35%. You want that in cash. Now you could even get a bit more, a bit more sophisticated and do more foreign currency denominated cash instruments. Because again, you're looking for stability. You want to preserve your money, your capital. You're not trying to get that lost. Then property becomes a bit more, your investment in property becomes a bit reduced. Why? You've done that over the years. You're getting rent now, I'm sure. You've made some good investments over the years. You're getting rental income. It's helping you out. You can pay for the fees here and there. So your investment in property will probably reduce. Then you're looking at equities. You could do some equities, but probably, do maybe about 15% in equities, because your need for that aggressive income, that aggressive return has reduced as well. So overall, your portfolio would look different from a younger person's own. Okay, so Abiola, you've said all these things. So how does this tie into investing in the equities market? I'm going to tell you about that just in a moment.
That 5 minutes madness only you can understand. Visit myspector.com to get your Spector experience. Spector, loans in 5 minutes.
What should I consider investing in the equities capital market? I've said all these nice things. So equities market is really the focus. What should I consider? Now, the first thing I would say about the equities market is that most people don't understand is it's a market that thrives on information. That's right, you heard me, information. You need to get information, the right kind of information. Now, we start with information first of all. I told you need to know who you are. I'm sure by now you already started thinking of the kind of person that you are. I hope you've sussed that out. You need to know who you are. Now, when you know who you are, the next thing is information. Information, the first information you first of all need to ask yourself is, when you know who I am, if I'm low risk, it means that I need to look for stocks that are not, that would give me comfort, that would give me the kind of income I desire, that would give me the kind of return I desire, but will give me minimal risk. If I'm high risk, I need to look for the stocks that have the potential to grow really well and do really well in terms of pricing, and may also, offer me the kind of returns I'm looking for. And if I am medium risk, I need to find a balance with both. So let's assume that you're a low-risk person. I'm typically for low risk, usually people that are old, that are in the retirement age, they're usually low risk. But there are some young people that are generally low risk as well. There's nothing wrong with being low risk. You don't have to be old to be low risk. You can be young and be low risk, right? Now, if you're a low-risk person, there's certain kind of investments that will appeal to you. Now, another thing to consider also again is, are you an active or a passive investor? Okay, Bella, I'm confused. What is active and passive now? Okay, so an active investor is someone who is very keen on the capital market and looks at it quite actively. That means you're engaging yourself all the time. You're looking at it, you have it on your phone, you want to know what's going on, you want to know the price of A, the price of B, you're active, you want to know. Passive investor, if you're like me, I'm a passive investor. I know, it's hard to believe, but I'm really passive. I don't want to look at my portfolio. If you're a passive investor, you're like me, it means that you don't want to look at your portfolio every day. You want to look at your portfolio just maybe once in 6 months, once in a quarter, once every other quarter. It's okay, nothing wrong with that as well. There are ways you can do both and you still be fine. There's nothing wrong with either one. So decide the kind of investor that you are. So assuming that you're low risk, there's certain kind of stocks you must go for. But how do you get the information? What do you need to do? Now, the first thing is look for a good broker. Every broker is good, but not every broker suits your taste or the things you're looking for. Every broker is good because we're all regulated by the Nigerian Stock Exchange and by the Securities and Exchange Commission. It means that we comply with very strict regulatory within very strict regulatory environment, and so every broker is good. What matters is the services they offer you. That's your choice to determine what you want. So let's assume that you're low risk. There's certain things that you must look for, as I mentioned. So you need to go and find out what sort of stocks are low risk. Now, typically, low risk stocks are stocks that are blue chip. They're called blue chip. Now, blue chip stocks are stocks that are perceived by the market as being of really good quality. Really good quality by why? Why are they good quality? What makes them good quality? What is so exciting about them? Why are they good quality? They're good quality because over the years, their performance has remained consistent. Then there are certain matrices that they're measured by, and they have continued to outperform those matrices. And in their industry, they're seen as a general outlier and and as a stock that is defensive, is defensive even when the market is down. That is why those stocks are referred to as blue chips. There are a couple of them in the banking sector, in the construction sector, in the oil and gas sector, as well as in the food and beverage sector. So you need to find what stocks are blue chip stocks. You need to know. So if you're a low risk investor, blue chip stocks are pretty much where you want to pitch your tent. Now, what are the characteristics of blue chip stocks? They typically will have a consistent dividend yield or dividend payout policy. So for example, there's some companies that pay out almost all their profits in dividend. So their dividend payment is good. Now, for also these stocks, what you also notice is that the price movement in them is not as, the swing, I would say, and their pricing is not as wide or is not as volatile as in some other stocks. They tend to be defensive, especially when the market is not doing great. Now, I remember I told you that in 2017, at the beginning part of the year, the market wasn't doing so well. And that started off from 2016. Now, the blue chip stocks went down in 2016 and early part of 2017. But when the market was recovering in 2017, they were the ones that recovered the fastest and the quickest and the best in terms of percentage terms. Because they're blue chip, it means that when the market was on the upward trend, almost everybody said, you know what, I need to get back into the stocks. I missed out. I don't want to miss out again. So that's what happens when you invest in a blue chip stock. In spite of what the market is doing, they would remain defensive. So the market will go down. They will go down or they may go down, but not as much as a stock that is not a blue chip. So if you're low risk, look for blue chip stocks. There are quite a few of them in the market, and you want to be able to look at them. I can name a few for you. And you're thinking, why would I know what a blue chip stock? I can name a few. So typically, a stock like GTB is seen as a blue chip stock. A stock like Nestle is seen as a blue chip stock. A stock like Nigerian Breweries is seen as a blue chip stock. So look for those stocks. They are typically seen as defensive stocks in spite of what is going on in the market. And they have a consistent and good dividend payout ratio, right? So you want to look for stocks like that.